Silver declined nearly 27% in a single trading session. Gold dropped around 12%. What we just witnessed goes far beyond typical day-to-day market volatility. This move reflects an extreme market dislocation driven by leverage, positioning, and broader macroeconomic forces. If you hold precious metals, if you're watching sharp drawdowns in your portfolio, or if you're trying to understand what caused such a sudden shift across global markets, this video will help put the pieces together. What happened wasn't simply about supply and demand in isolation. A combination of structural, institutional, and macroeconomic factors aligned at the same time. Factors that often receive limited attention in mainstream market coverage. In this video, I'll break down these drivers step by step, explain how they interacted, and outline several plausible paths forward. I'll also discuss how different types of investors may think about positioning during periods like this. This analysis is based on observable market data, historical precedents, and widely documented market mechanics, while recognizing that markets are complex and outcomes are never guaranteed. Let's start by understanding the magnitude of what just occurred. In this scenario, gold experienced a rapid decline of roughly 12% within hours. Silver fell even more sharply, with losses approaching 25 to 30%. For precious metals, moves of this size over such a short time frame are extremely rare in modern markets. To put this in perspective, a heavily allocated silver position could have seen a substantial portion of its value erased almost overnight. This type of move reflects not only price discovery, but also forced positioning changes across derivatives markets. Large amounts of market value were wiped out across futures, options, and leveraged accounts. Stop-loss orders were triggered, margin thresholds were breached, and liquidations accelerated the downside. Just weeks earlier, highly optimistic price projections for silver were circulating widely across social media and trading communities. That optimism reversed rapidly, illustrating how quickly sentiment can shift when leverage and expectations become stretched. The key question now is whether this move represents a temporary reset or the beginning of a broader consolidation phase. To understand why precious metals declined, we need to look at the US dollar. Gold and silver have historically shown an inverse relationship with the US dollar index. While not perfect on a daily basis, this relationship has remained one of the most consistent long-term correlations in financial markets. Recently, the dollar has shown notable strength, breaking above several resistance levels. A key driver behind this has been expectations around US interest rates. Federal Reserve communication has suggested a willingness to keep rates elevated for longer than some market participants previously anticipated. Higher interest rates tend to attract capital into dollar-denominated assets, such as US Treasuries. As demand for dollars increases, the dollar strengthens. A stronger dollar generally places downward pressure on commodities priced in dollars, including gold and silver. This dynamic reflects standard capital flow behavior in international finance. Institutional participants closely monitor these relationships, while retail traders often focus only on metal price charts. Now let's talk about an important distinction between gold and silver. Gold functions primarily as a financial asset. Silver, however, has a dual role. It is both a monetary metal and a critical industrial input. A significant portion of annual silver demand comes from industrial uses. Silver is used in electric vehicles, solar panels, semiconductors, medical devices, and various advanced technologies due to its exceptional conductivity. China plays a central role in global manufacturing and industrial demand. Recent economic indicators have shown signs of slowing factory activity and softer industrial momentum. When industrial demand expectations weaken, silver tends to be affected more than gold. This dual exposure helps explain why silver underperformed gold so dramatically during this decline. Understanding this distinction is critical. Gold and silver are related assets, but they respond differently to changes in economic conditions. One of the most significant accelerators of this move appears to have been changes in margin requirements within futures markets. Over a relatively short period, margin requirements for silver futures were raised multiple times. Margin increases require traders to commit more capital to maintain positions. For highly leveraged participants, these increases can force rapid decisions, either add capital immediately or reduce exposure. When many traders face this decision simultaneously, selling pressure can intensify quickly. As prices fall, additional margin thresholds are triggered, leading to further liquidations. This creates a feedback loop driven not by changing fundamentals, but by risk management mechanics. Historically, margin adjustments have played a role in amplifying volatility during periods of speculative excess. While exchanges implement these measures to manage systemic risk, the short-term impact can be sharp and disorderly price action. An interesting development during this period has been the divergence between paper pricing and physical market conditions. While futures prices declined sharply, reports from various regions suggest elevated demand for physical silver, longer delivery timelines, and higher premiums relative to spot prices. Some mints and refiners have reported production constraints or temporary allocation systems. In certain markets, physical premiums have risen significantly. This type of divergence can occur when futures markets are dominated by speculative positioning, while physical markets reflect longer-term supply and demand dynamics. Such conditions do not guarantee immediate reversals, but they highlight structural differences between paper instruments and physical commodities. Looking at history can provide useful context, though it should never be treated as a forecast. Moves of this magnitude have occurred only a handful of times over the past several decades. In some instances, sharp declines were followed by strong recoveries. In others, markets entered extended consolidation phases. Outcomes depended on broader macroeconomic conditions, monetary policy, and inflation dynamics. Today's environment shares characteristics with multiple historical periods, which makes the path forward uncertain. Rather than predicting a specific outcome, it's more useful to recognize the range of plausible scenarios. How investors respond depends on their objectives and risk tolerance. Physical holders focused on long-term wealth preservation may choose not to react to short-term price movements. Leveraged traders may reassess position sizing, cash buffers, and overall exposure, particularly during periods of elevated volatility. New participants might consider gradual entry approaches, such as dollar cost averaging, while ensuring they understand the differences between physical ownership and paper instruments like exchange-traded products. Across all strategies, emotional discipline remains critical. Markets tend to reward preparation and risk management over impulsive reactions. In summary, this move appears to have resulted from a convergence of dollar strength, industrial demand concerns, and leverage-driven market mechanics. This content is for educational purposes only and does not constitute financial advice. Market conditions change rapidly, and every investor's situation is unique. Volatility can feel unsettling in the moment, but periods like this often provide valuable lessons about risk, leverage, and market structure. If you found this analysis helpful, consider liking the video and subscribing for future updates. Thank you for watching.